Hi, this is Audrey Whittington with Realtor.com, and today we're going to be talking about economic insights. And I'm pretty excited about today's topic because we're going to be talking about the 2019 forecast with Danielle Hale, the chief economist at Realtor.com. So Danielle, like everybody wants to know, what do we have to look forward to?
Well, it depends on whether you're a buyer or a seller and whether or not you're looking forward to this year, right? So our 2019 forecast calls for a tougher road ahead for both buyers and sellers. That's not to say that it's going to be impossible, but there are factors that are going to make 2019 a little bit more difficult, regardless of what side of the housing market you're on. So to dig into buyers for the first perspective, buyers have some bright spots. We do expect more inventory in 2019 coming to market, so they will have more options to choose from. However, it's not going to be so much inventory that we see a lot of price pressure.
Right.
We see home prices slowing, so they will grow at about 2% pace instead of the 4 to 5% pace that we've seen in sales prices recently. So a slower pace of increase, but they're still increasing. So buyers are still looking at more expensive housing, coupled with the fact that mortgage rates are rising. So that's a trend we've had for the past couple years, and so we expect that to continue in 2019. Mortgage rates at the end of 2018 are going to finish the year right around 5%, and we expect them to finish next year around 5.5%. So they'll be about a half a percentage point higher. Those two factors combined, price increases and mortgage rate increases, mean that we're looking at about 8% more in the monthly payment. So then you combine that with income growth of around 2 to 3%, things are going to get a little bit more expensive for buyers, and that's why we say it's going to be tougher. It's not impossible, but if you've been looking for a while, it's not going to get easier on that front yet.
So they might start to feel a small squeeze, but not a lot. I mean, what I heard was about a 5% differential, right? Between it seemed that mortgage rates have been pretty steady, and I think the Fed just came out and said that they're actually going to hold mortgage rates. But you're saying you think we'll see a bit of an increase next year?
Yeah, so it's hard to interpret what the Fed says. Some people did read Chairman Powell's comments recently as we're going to wait and see, and he did emphasize that the Fed is being data dependent. So they're looking at the data and how data on the economy evolves and what that means for the rate path. They've been in this tightening cycle for the last couple years now, and we expect it to continue. Most forecasts had called for 3 to 4 increases in the Fed rate, the Fed funds rate next year, so 2019. We're expecting 2 to 3. In line with continued growth in the economy. But if for some reason economic growth shows signs of starting to slow, which it hasn't yet, but it could, if it does, then they might ratchet back on their expectations for the Fed funds rate increases that they're planning to do. And he said, we're closer to the neutral range on the federal funds rate. And earlier in the year, in October, I think it was, he had said something about, we still are a couple steps away from a neutral Fed funds rate level. So those two things are consistent. He hasn't really changed his position, but he has changed the focus of his position. That's caused some people to think, well, maybe they're going to move slower than they otherwise would have.
Let's talk about the Fed funds rate. What does that really mean? How does that play in? I think a lot of consumers don't really understand what that is.
Yeah, so the Fed funds rate is a short-term rate that they set for overnight borrowing between banks. And it has this cascading effect of, once the short-term rate is set at the rate that it's set, then that impacts long-term rates because you can create arbitrage opportunities to make money. Basically, you can loan the Fed money, banks can, on a short-term basis, and then lend it out to others, and that basically cascades all the way up the yield curve. So mortgage rates are affected by those short-term rate trends and affected by the same factors that drive those short-term rate trends, so the overall strength of the economy, but they're not tied together in lockstep. So mortgage rates, most people take out a mortgage for 30 years.
Sure, or 15.
So right, 15 or 30 years, so long-term rates. And then they tend to stay in their homes for about 10 years. So we see mortgage rates tied very closely to the 10-year rate because that's sort of the time horizon. It's a similar time horizon. And the 10-year rate is affected by these short-term rates, but also by the general outlook on the overall economy, because people are thinking about not just what's going on now, but what's going to happen over the next 10 years. So that's why the Fed funds rate is sort of important to the mortgage rates, but so is the general economic outlook.
And I think in terms of the general economic outlook, obviously there's a lot of politics involved and sort of where we are politically. So how does a buyer navigate all of that? So they're on Realtor.com and they're looking. How do they navigate and decide what to do for 2019?
Well, they can do things like look at our forecast, so they don't have to try to piece together their own trends based on what they see in the market. We've done that for you, so by all means, look at our forecast. We expect mortgage rates to continue to increase based on the fact that we expect the economy to continue to improve in 2019. And so we'll go from about a 5% rate at the end of 2018 to roughly a 5.5% rate at the end of 2019. So a half a percentage point increase. It's not terrible, but rates are going to get higher. So if you're thinking about this from the perspective of a buyer, you want to think about how you'll navigate this, right? So think about what you qualify for now in a home, and maybe test out what happens to your budget if mortgage rates do go to 5.5%, so that you don't have to totally revamp your search. You already know what your budget limit is at that higher mortgage rate.
Well, let me throw you a bit of a curveball, okay? So what about the tax bill? How does the tax bill affect the housing market?
Yeah, so the tax bill.
And I know you're not a tax expert, so do the best you can here.
All right, so the tax bill, so it's not new. It passed at the end of 2017.
Right.
It's been in effect for all of 2018, and in fact, most people have probably already seen slightly higher take-home pay because the IRS changed withholding to account for the new tax plan.
Yep.
But no one's actually filed their taxes under this new plan, because you file your taxes sometime between January, February, and April when they're due. So that's when it's really going to hit home for a lot of homeowners and renters. Are going to see exactly how much they benefit or lose out from this tax plan. We know that the tax plan had a couple of changes that directly affect the way homeowners and renters are going to do their taxes. So for renters, they didn't really have a lot of tax benefits under the old tax plan. So for most of them, it's going to be a positive. They were less likely to itemize deductions because of the structure in the old tax plan. And should be more like, so they should benefit from the higher standard deduction.
That's good to know.
For homeowners, they were likely to itemize under the old tax plan. About half of homeowners itemized under the old tax plan.
About 50%, Interesting.
Because you have to have mortgage debt. So about a third of homeowners don't have any mortgage debt. So they weren't necessarily key or likely to itemize. So they're less. So homeowners were likely to itemize, and they may not going forward because there's a limit on the amount of mortgage interest you can deduct. So
and that's the new part, right? I mean, basically, when you talk about itemize, you're talking about basically deducting it. So it was a powerful deduction for homeowners. And you're saying that now there's a cap, so people really can there's a limited tax advantage.
Yeah, for deducting mortgage interest. But actually, in fact, the bigger change is that the standard deduction. So let me take a step back. So there are two ways to do your taxes. You can either take the standard deduction, it's a lump sum, you subtract it no matter how you spend your money, how much you give away, how much you save, it doesn't matter. You take the standard deduction and then you subtract that off your income, and then you pay taxes on the rest.
Okay, good.
Or you can itemize your deductions. So you don't take that standard deduction, instead you're going to list out specifically the tax advantage things you spend your money on. So you get to take money off for mortgage interest. You used to be able to take state and local income and property taxes unlimited. That's a change. So your mortgage interest is now limited. You can only deduct up to $750,000 interest on a mortgage up to $750,000 versus $1 million under the old tax rules. You used to get unlimited state and local taxes. Now you can only deduct up to $10,000.
Oh, wow.
Charitable contributions, you can deduct those from your income as well. That was unlimited, it stays unlimited, so no major change there.
That's good.
And there are some other minor tweaks, but those are the big ones. But ultimately, it only makes sense to itemize if the dollar amount of your itemized deductions exceeds the standard deduction.
And
so the fact that the standard deduction into the new plan is roughly double what it was under the old plan means we're going to see way fewer itemizers.
Okay, I feel like that was a little mini tax course. That was awesome. So you're definitely more of an expert than you say. So hopefully that's super helpful. Let's kind of change gears here a little bit. Let's go left and let's talk about Amazon. Let's talk about the Amazon headquarters. Obviously, there was a huge announcement being in New York and in DC, or the Northern Virginia area. So what is your take on sort of that announcement and how it'll affect those housing markets?
Yeah, so
it's a big question right now.
Yes, so the nice thing for, there were 20 candidate markets, 19 in the US and 1 in Canada. And the nice thing about Amazon choosing New York and the DC area, specifically Northern Virginia, is that those are among the biggest markets that they could have chosen. So when you think about the disruption of a new company coming in with 25,000 jobs, those are big job big jobs markets, and so it's going to be less of a boost relative to if they'd gone into a smaller market where the market would have been overwhelmed.
Where they would be the number one employer.
Right,
whereas in DC, really the government is the number one employer.
Yeah, that's true. So it's still a big boost for the local economy, but it's sort of, in both those cases, it's comparable with the number of jobs that are added in a year or so, whereas it would have been what other markets typically see in 5 years. So it'll be a more manageable increase for these markets. But it's still going to be an increase, and it's going to shape the local markets, particularly in the areas around where Amazon's going. So in the Northern Virginia area, they're talking about the area between Arlington and Alexandria.
Excellent.
They're calling a new neighborhood National Landing.
Oh, really?
Yes, and in New York, they're going to be in Queens in an area known as Long Island City.
Right.
It's just across the river from Manhattan.
Yep.
So you're going to see the biggest effects on the market in the areas that are nearby.
So we say 5 miles, 10 miles.
Yeah, so we studied Seattle, and we looked at the biggest effect was in an area within 5 miles.
Right.
Because of the higher density in these two markets, the effect could even be more compressed in the DC and New York areas, but that sort of remains to be seen. We see in Seattle, so we looked at expansions of Amazon in Seattle. The biggest effects within the first year were within 1 mile of the Amazon
that
campus.
Makes sense.
And then long term, like over the next 10 years, we saw large effects within 5 miles. And in that first year, home prices grew at double the rate of the surrounding area.
Wow.
So it's not a small effect.
No, it's not. And I know that people in those areas are pretty excited. So good time probably to either be buying or selling in those markets.
Yeah, absolutely.
But one of the things you mentioned was that the surrounding markets, the sort of runner-up markets, also should feel the effect.
Yeah, so the runner-up markets, I mean, they have the things that Amazon was looking for, like a good housing market, a good, strong labor economy with lots of educated workers, nice transportation infrastructure. I mean, those factors are already in place. So that's going to make those other markets attractive. Even though Amazon didn't select them, other companies are likely to move in there. So I think they're going to be just fine.
That's just what I was thinking, is that other large companies will use that as sort of a list.
Right. Amazon's done the research for them.
Exactly. Well, this was super helpful. I have learned a lot about 2019, and for the most part, I think it seems pretty good. So thanks for joining us. And thank you for joining us with Economic Insights with Danielle Hale and Audrey Whittington at Realtor.com. Please check out some of our other videos.